Hi, folks. Welcome. I would encourage those in the back eating and drinking to come and join us because we're going to be having a very good conversation about possibly the most discussed economic potential scenario, the one with the most risk, which we colloquially refer to as stagflation, but has kind of a murky definition. I'm Oliver Rennick. I'm the lead anchor at the Schwab Network. I'm happy to be joined by a very esteemed group of panelists. I will go ahead and begin the introductions while you guys get settled. To my left, Nancy Davis is the founder at Quadratic Capital Management. Nancy's a regular on my shows. I love Nancy's view on correlations, cross-asset relationships, and I think we might get into a little product talk at some point in this discussion and have some very interesting products related to bonds. To her left is Peter Bookvar, the Chief Investment Officer at Bleakley Financial Group. Peter, it's a pleasure to meet you in person. We followed each other on Twitter for a while. I love your macro thoughts. Peter is a much needed voice of reason from the contrarian group, but he doesn't drift. You run in the same circles as Peter Schiff, but you guys aren't on speed dial. And my pleasure to also introduce Mike McGlone, Senior Commodities Strategist and a Macro Strategist for Bloomberg Intelligence, a former colleague of mine and somebody I learned a great deal about technical analysis from, and I'm grateful for that, and it's a pleasure to be with you again, Mike. Great to see you. So in the discussion of stagflation, it, I think, behooves us to kind of start by trying to figure out what exactly it is, how to define it, because really other than like one period really in history when a British politician coined the term, it's been something kind of amorphous that a lot of people have talked about in the past year. Even if you just kind of look at different Investopedia, Oxford Dictionary, you search it online, you're gonna find different definitions of stagflation. Some say it requires a sharp rise in unemployment. Some say it requires persistent inflationary prices. But the one thing I found that all the definitions have in common is that it involves high unemployment. So in our conversation, we want to start, I think, by trying to have a definition, figure out if maybe right now there are some criteria that might meet the definition of stagflation. Then we'll kind of break it apart, think about the stag component, think about the deflation component, and then maybe how to deal with that. We were talking earlier, Nancy, so I'll kind of give you the ground first here about the last year. As we go into 2024, 2022's bear market of bonds down, stocks down. A lot of people threw around this term stagflation. And I guess if we think about it, without any nominal levels required, like if stagflation doesn't require an unemployment level of 5, 6, 7%, then is it possible we have seen some version of that here kind of within the last couple of years? Do you think that's a fair kind of starting point in this discussion?
Yeah, I think it's a great point. It's a pleasure to be here with my esteemed panelists today and at this conference. And we really appreciate your focus for those of you joining in the audience. Thank you. Yeah, I definitely think, we could look at the price action in markets in 2022 and say, maybe we're experiencing some kind of stagflation being priced in then, because the definition, economics aside, it's typically higher prices and lower growth. And that's typically when stocks and bonds sell off together, which is exactly what happened in 22. So, definitely to your point, we could have already had a period of stagflation.
I think that's really important because there is, in markets, there are nominal levels. A company reports earnings, and did they meet that number versus how did their earnings change? When we talk about stagflation, I think there's a similar thing we have to establish from the ground level, which is, does that definition require some very high level of unemployment? Does it require 9% inflation like we got last year? Or, Peter, could it just be a period in which growth is going down and inflation's going up?
Well, in a way, they're intertwined in that the inflation is what causes the stag. It's the higher cost of living where wages don't offset that creates the stag. It's the higher cost of doing business that reduces your profit margins that create the stag. So they are intertwined. I mean, there's this belief, particularly in Japan for 30 years, that you need higher inflation to create faster growth. No, you can have faster growth with it's low inflation. It's actual legitimate price stability that is the foundation for healthy growth. So unfortunately, we have the situation right now with this dramatic cost increase that, like I said, is creating the stack.
When we think about just very recently, in the last couple months, technically, our unemployment levels are pretty reasonable right now. We're still below 4%. But I'm curious, almost from a chart perspective, Mike, if the unemployment level, which is kind of steadily rising right now, and actually since June, our CPI, if we go with CPI, it bottomed out and has been rising again for the last 3.5 months. We've got an unemployment line that's slightly rising. We've got an inflation line that's slightly rising. Are they rising fast enough, big enough for us to have a real discussion about stagflation in the way that we might in 1970? Oh, we need a little, maybe pass over to Mike there.
The inflation bounce is a tech path, and it's the base. Simple fact of the base. We look at CPI; it's running just below 4%. Core PCE, employment cost index, around 4%. That's double the Fed's target. But the recent bounce was because of a little spike in oil and some other things, right? Look at the facts. Look at the facts of this year. The low for CPI annualized this year is minus 3.1%. That's deflation. You know what the low was in 2008? About zero. The high was 9.9%. The difference is the base. We have still it was just July, we had the last rate hike. So what I see now is a classic monetary cycle that's similar to 1929 to 1930. It's spelled out in the book Boom and Bust. There's some other books spelled out in it's classic Milton Friedman. We are heading to a severe deflationary reset. So let's start with one. I'm a commodity guy. So let's look at crude oil. The average price this year, $78 a barrel, was first traded in 2007. Imagine if we said that about the stock market. Now you do parts of the world, things like the Nikkei. You look at natural gas. The price of natural gas is a benchmark measure for heat, electricity, and fertilizer in this country. It's down 80% from last year's high. First traded in 1990. So severe deflation just starting to kick in. And let's remember the one main reason that started it was money supply. We took our money supply, we bumped it up, M2, up 42%. Now from the end of 2019, it's only up 37%. Now it's negative, down, running minus 4%. The rules of pumps and dumps and liquidity are just starting to roll over. And I think what's going to happen within a year, we'll get a normal recession. That's the view we have from Bloomberg Economics. But to have a normal recession after the biggest pump in liquidity and the biggest dump in liquidity and hike in rates on a global basis would be this kind of strange. We should get a normal type of similar, might be worse than 2008-9. But remember what happened is this is on the back of the longest period in the history of zero interest rates globally. They're negative. And Japan, it's been 20 years. In Europe, they've had negative rates. Well, and we've ripped the Band-Aid. So I'll just end with some facts. In this country, container board demand, corrugated boxes, down about 10% from the peak. That's about the same velocity as 2008, right when the recession started. Diesel demand is down about 10% from the peak. Unleaded gas demand is down 5% from before 2019. And natural gas demand is at the lowest industrial since 2007. So from a commodity guy, inflation guy, I see severe deflation kicking in. And there's one key thing that'll stop it right now. And that's the stock market staying elevated. But if we get a normal correction in the stock market, that's a domino effect.
2 points there I want to counter with and have you respond to. Number one is mathematically rate of change coming off a period in which the entire economy around the world was shut down. We have no history of that. So naturally, all these prices are going to come down, which is kind of a goalpost argument. The question I would ask you to follow up is, do those commodity price declines that you're describing, though, act as a stimulant in a way to a consumer who a year ago was dealing with a much more sluggish economy? Now they've actually got a 4.9% and their oil's quite a bit cheaper.
They will when they get cheap. if history is a guide. So it's not just do commodities. We'll start with CPI. Well, the number one component in CPI is owner's equivalent rent, which is based on homes. The average median price of a home in this country has doubled in 10 years, from around 200 to 400. So that base is pretty darn high. Just got to trickle down a little, like it did from 2006 and 2011. The big difference was the Fed started easing in 2007. We're not getting that. So from a commodity standpoint, here's my outlook. I said it a year ago, and I'll repeat what Roger Babson said in 1929. I'll repeat what I said a year ago, and this is the fact is I think crude oil is going down to $40 a barrel. Why? Because it's made lower highs and lower lows since the peak in 2008, and the average cost of production in this country is around $60 a barrel, and we have an excess of supply in this country. We are producing, and in Canada, it's about 6 million barrels a day. In 2008, it was a deficit. And if you include the surplus out of Saudi Arabia, it's massive. Who's getting hurt by this? China. There's a net importer. So from that standpoint, what typically happens is you need to get cheap to reset. You need to shut off that supply, increase the demand, and we're nowhere near that. And that's what happened recently. Had this little spike in unleaded gas and crude oil, and the ECB hiked, the Bank of England hiked, the Fed said they would, in July they did. And that, I look at it, if we had dripped lower already, the Fed would have hiked another 100 basis points this year. So it's the number one thing now is liquidity. Liquidity is negative. Like I like to point out, money supply is negative. Just the rules of money markets and business and finances. When you get that 2-note at 5%, you see money supply is negative. You're supposed to say thank you very much, which is what Mr. Druckenmiller did recently.
Nancy, I want to ask you something about how the past year in markets has been so different for the most part from the year prior. Maybe not in the last 3 months since the 10-year ripped through 4%, but there was a period that was discussed earlier this today as well, in which yields were going up, stocks were going up too. Last year's boogeyman of that correlation broke. Does that at all speak to the possibility that our economy might be able to navigate without that type of detrimental stagflation situation? If we kind of go from price, what has the market told us the past year about these risks based on how stocks and bonds have traded?
Well, it's been a tale of two different markets. You know, in 22, stocks and bonds were both down together. This year has been a huge bond bear market. The Fed coming out in September and saying higher for longer. Most funds that are long bonds are down during this period pretty hard because all bond funds are long duration. It's just a few funds that are actually short bonds or have a way to have convexity plays are up. And so it's definitely a really dynamic environment because we have the bond markets are screaming and are saying there's a big problem, and equities seem to be, you know, humming along so far. But I think it's going to be interesting, especially like we had a really soft payroll report on Friday. It'll be really interesting to see kind of how that plays out with monetary policy, because the Fed, although they've been hiking rates a lot, they still haven't really touched their balance sheet. And the balance sheet expanded in the 8 weeks following the start of the US COVID pandemic, so March 2020. In that 8-week period, they did more QE in 8 weeks than they had done in 9 years prior to the pandemic start. So the balance sheet is enormous, and a third of the balance sheet is mortgages. And we look at, you know, to your point, Mike, the home market, it's really a case of have and have nots. I mean, people who do not own a home cannot afford to buy one because real estate prices are very high, and mortgage expenses, because interest rates are higher, is incredibly not affordable for most people. So it's really a tough environment, but I do think any place that you have, you know, the ag index is now the Bloomberg ag, it used to be the Lehman ag and then the Barclays ag, but any place that you own funds or any type of product benchmarked to the ag, it's just really important to understand that the ag is about 27% mortgages, and the ag has no inflation protection in it. So having things like commodities, gold, other asset classes, like even tips, there's no tips inside the ag because they were only started by the US Treasury in 1997. So it's just really important to kind of look under the hood and don't think stocks and bonds. You have to look at inside the bond fund what these strategies are doing.
It kind of sounds like you might argue that even if we may not meet some specific definition of stagflation at the moment, it's not worth risking it to be perfectly kind of allocated in a world in which that's not going to happen, to have something there just in case.
Yeah, and I think that goes to the point of non-correlated assets, right? If everything in your portfolio is going up or down together, that's a problem. And so we've been really fortunate since the financial crisis that for most of the time, stocks and bonds have been going up together. 22 was a wake-up call where people really needed to rethink correlation, other things in the portfolio. But I think it's super important. You just want to have a lot of diversification because you can never predict what central bankers are going to do. You can never predict geopolitics. You can't even predict things like stagflation because we do have a really, the labor market has not totally collapsed yet, but, who knows? It seems like it's getting weaker.
Hey, we're only 1 month out from a 300,000 NFP print. Peter, I know you think a lot about the Fed and macro stuff, but if you will for a second, I want to ask you about what you saw in the last earnings season, the one that's developing. I was reading one of your recent notes. I thought I had a really good deep dive. You looked at companies like Amazon, Capital One, trying to find signs of that strain where prices are higher and demand is weak. How glaring are the signs? How comforting are they? What did you find?
Well, it's important to slice and dice the economy because people like to talk about, is it strong, is it weak, is it this or is that? When you look at the existing home market in the country, it's the epitome of stagflation. You have prices up 45% over the last 3 years. And in the weekly mortgage application data, purchase applications are at a 28-year low.
That's a fantastic point.
That's the epitome of stagflation. You have manufacturing, not just in the US, but globally, is in a recession. And keep in mind, with existing home sales, for every new home that's not sold, there's less carpet that needs to be put down. There's less paint, there's less hiring movers. There's a lot of peripheral activity that does not happen when you don't get that existing home sale. Now, you can say, well, if people are going to stay in their homes, maybe they'll renovate it, but they did that already in 2020, 2021 during COVID. With respect to the consumer and to your point about what are these companies saying, that's bifurcated too. The lower income consumer is clearly stretched. When you see numbers at a Dollar General and Dollar Tree and McDonald's, and they're talking about how stretched their customer is, that says a lot when you can barely afford a cheeseburger. But even the higher income consumer, which is more flush, and that's where a lot of the spending is happening. But you have Walmart talking about more people making over $100,000 shopping in their store. McDonald's even talked about it a couple weeks ago in their earnings call. When you have Conagra talking about, and they get this information through surveys, saying that people are paying more attention to the inventory in their pantry. They don't want things to go to waste. And when they want to cook a meal, they're not just cooking for themselves, they're cooking for multiple people so it lasts multiple meals. There is a stress out there in the economy. And even when you look at the Q3 GDP, which was around 5%, business investment was flat. So this inflation-deflation argument, I see the 1970s. We had a spike in inflation. Now we have the come down. But we are not going to be investing in things for the next couple of years because of the high cost of capital. If you wanted to build a multifamily apartment building today, you would not be able to do it. You would not be able to raise the equity, and you would not be able to get a loan. So while there is about 1 million units that are currently under construction right now, and rental prices will be subdued for the next year, after that, rents are going to skyrocket because of an 8% mortgage rate. That first-time buyer is going to be renting and not buying, and there's going to be almost no new supply after the current batch is done. So we're going to get the dip in prices, and prices are going to go straight back up because there's going to be a little capacity being added in the economy during these couple of years of a much higher cost of capital.
So you've got to think that traditional inflation metrics are going to be going quite a bit higher when that kicks in, because that's a huge component, rent. You're saying rent's going to come back after being one of the biggest disinflationary components of the past year.
Yes. I guess my bottom line inflation, I'm expecting a lot of inflation volatility. And volatility with a higher low. The important thing to look at with inflation is, there are two components. Services inflation, there was nothing ever transitory about services inflation. Services inflation ex energy in the 20 years leading into COVID averaged 2.8% a year. Nothing transitory about that. Goods prices, core goods prices averaged 0. So you want to get the inflation story right, you got to get the goods price right. And with the labor costs going up, even though they're plateaued, they're still running about double where we were pre-COVID. There is a structurally higher cost of doing business that I think is going to lead to structurally higher inflation. Not 9% inflation, but something like 3 to 4 instead of 1 to 2.
Mike, I can see you itching
On a
because
sustainable basis. After this downturn, on a sustainable basis.
I mean, that's a pretty big argument against what you were saying earlier, right? Because what you're describing, packaging, goods, et cetera, that's essentially the manufacturing inflation that was arguably very COVID specific. What Peter's saying is that services inflation will be persistent, which challenges the deflation view you laid out.
So Peter and I can make a good market. We'll make a tight spread. So first 2 books. Price of Tomorrow by Jeff Booth, a New York Times bestseller about how deflationary forces in technology. Superabundance, another book. I read like a few chapters of that and I got the key point. I'll point out how deflation is significantly part of what's happening in the world. First of all, let's start macroeconomic. China is very much, I think, similar to what I read in the book Atlas Shrugged, a combination of peak Japan and a combination of peak Soviet Union. Bloomberg Intelligence estimates that the amount of the property value in China that's at risk of default is about 12% of GDP. So it's just a normal reversion overdue and a classic catalyst, completely autocratic leadership. We know what happens with that. We've seen it. So it's tilt over. So that's macro, it's global. Europe's in a recession and they just tightened recently. PMIs are negative. Retail sales are negative, ex inflation. In this country, retail sales are negative, ex inflation, and the Fed's still tightening. So we have kind of a global problem there. And then the dollar break, the dollar is the wrecking ball. Why is the yen dropped almost 50% in 2 years and the yuan still collapsing? Because they can't keep up and their rate's almost 0 and the US is at 5%. So there's the macro. The US still towards recession. Let's look at housing in the US. Existing home sales is about the lowest level versus the ratio of new homes under construction. And the ratio of total new homes under construction in this country is almost the highest ever. And you know what happens with that? It means the inventory comes on, and a lot of those deals are already done. Unemployment. Unemployment just bottomed from 3.4%. In the history of unemployment, our data goes back to 1940. It's never bottomed from a low this level without going back to 6%. 6%, about 7% is the average since about 1940 in this country. So we just bottomed. We have just a simple mathematics of it. And almost every single time we've had this point, it starts inching higher. The Fed's already started to ease. So to me, this is a classic cycle that it's a 100-year cycle. We've never had this long period of 0 interest rates. We've never had a period where 3 years ago, everybody in this country thought we were going to die. And there was a risk we could die. Some of us knew a lot of people who did die. There was a good reason to pump the liquidity system. Poof, that ended. We got vaccines within 6 months. China messed it up. So to me, these cycles are just getting started. And where you see it is, first of all, I'll end with 2 things. Leading indicators in this country are minus year over year, minus 7.8%. We've never had it that low for that long without a recession. That's a 100-year piece of data. And I look at it as, yes, we're impatient, but we also had something that happened that never happened in the history of this country. Is we increased our deficit this year around 8% for a while. We've never done that absent a recession or war. So how have we goosed the economy? Massive fiscal stimulus. And because of that fiscal stimulus, we've tightened another 100 basis points this year. And the lessons are all about liquidity. So to me, this is just a normal cycle. So I'll end with this, I guess. The last 2 corrections for recessions in this country, S&P 500 dropped 50%. And the Fed started easing well before they met their lows. In SEP 2007, the low wasn't until 2009. And beginning of 2001, the low wasn't until the end of 2002. So why should it be different this time?
Today we have one big exception, though, if I may, which is that over the last 3.5 months, we've had yield curve steepening, 10s to 2s, that simply just does not happen into a recession. It can happen before, but it always comes back and inverts again going into the recession. Let's come back to the trading situation because that is unprecedented. Nobody thought the yield curve would be widening out at this point, which brings me back to where we started, which is basically stocks may be okay with yields going up if they go up in a certain way. Last year, yields were going up, but the curve was flattening. This year, yields go up, curve is steepening out. I'm curious how that fits into this discussion, especially when it pertains to what we do about the risks. Because even though we look at the nominal long yield and it's going up like it did last year, under the surface, we have literally almost an opposite situation. We almost uninverted without Fed cuts. It's never happened. It's never happened.
Yeah, no, it's never happened. It's
We literally are in unprecedented times.
yeah. No, I mean, there still is such negative term premium. Like, I like to think about the yield curve as, giving Janet Yellen a loan, right? It's loaning the U.S. Treasury market, right? I think it's a simple way
the
to
term
think.
premium is basically the credit risk.
The credit, it's saying, here, Janet Yellen, here, U.S. Treasury Department, let me lend you money for longer. And we've had this negative term premium, like the most negative term premium that we've ever had, ever, in the history of financial markets. And it's been inverted for longer, forever, like longer than any other period of history, even going back to the 50s. So it's been a really, really bizarre time because I want to grab people. And I think going into 23, so many people were scared because stagflation was, the topic du jour. People were seeing their stocks and bonds lose money together. And so the group think was, let me buy the 10-year. 10-year is not risk-free, right? But a lot of the models assume it's risk-free. So a lot of people are so bearish on the economy, on equities, that they're just rushing and buying duration. But it's literally, it's not normal to have such an inverted yield curve. And the curve has been uninverting, but it's still negative in, if you look at the choose 10 swap market, which is a much bigger and broader market than the Treasury market, because the Treasury market actually demands funding. You can repo it out, but it's still, you have to have cash. The unfunded market, which is the swaps market, is still really negative, and it's still not normal. And so I think that's one of the things that I'm pretty excited about, is seeing a more normal yield curve, and that can happen in so many different ways. It could happen because of stagflation. It could happen because the Fed cuts rates, because of a weak economy. It could happen just because of the rest of the world saying, hey, Janet Yellen, we're not going to give you money longer for free anymore. And we're, given the fiscal spending and the situation in the U.S. and with the Treasury having to refinance, about a third of our debt is coming due in the next year, people will expect at least some term premium, which is normal, right? That's not like some tail event. Having a normal upward sloping yield curve today is not normal. The inverted yield curve is not normal. It's only happened in my lifetime 4 times. And it usually precedes something bad, right? Like it's, people always say, like, is it a predictor? Is it a cause? Like, I don't know. I'm not going to sit here and speculate which comes first, but having an inverted curve is not a normal thing, and we're still in curve inversion.
True. Very good. Well said, too, especially about the term premium. I think is such an important discussion. I thought Ira Jersey from Bloomberg did a good job describing the role of the deficit earlier. Peter, I want to throw this your way, because in that conversation right now, as that term premium crosses positive, to Nancy's point, for the first time. I mean, the long-term chart of the term premium is mostly, almost always positive, goes negative for like the last decade. We're coming out positive for the first time. As a result, a lot of people are now saying this is a referendum on deficit. This is it. We're going to hear from crypto folks who are loving this right now. Gold folks are loving it because they're saying this is the market saying, yeah, you can't just sell bonds at whatever price. But history tells us positive term premium is pretty normal. So how is that informing the decision on where to be if maybe we navigate this with something more traditional, not a big referendum on the way deficits work?
So I'm going to start by being really hyperbolic right now. When we had $18 trillion of negative yielding securities, it was the biggest financial bubble in the history of bubbles, was the sovereign bond bubble. I mean, when you think about a negative yielding bond, it's the epitome of a bubble, because central banks, through alchemy, turned an asset into a liability just overnight. And it was the ultimate hot potato. So what we're seeing now is, and I'll stop being hyperbolic in a second, an unwind of this great sovereign bond bubble. And what's happening now is it's not just U.S. debts and deficits. The U.S. 10-year, you look at a chart, within a day of the BOJ widened yield curve control on July 28th, but it was a day or two before where they leaked it. And that's when you started to get a move higher in the 10-year yield. And then they followed through a couple days later. That was the light under the fire to get a global rise in interest rates. Everyone talked about deficits, but I tie it to what the BOJ did. Because they're the author of modern day zero rates in QE. You know, Ben Bernanke didn't think of this out of thin air. He saw what the Bank of Japan did. So here, finally, you had the last major developed central bank that was joining the monetary tightening party, call it. So now you had that. You have the ECB that is picking up the pace of QT. The Bank of England, and that's outright selling gilts. The Bank of Canada is selling Canadian bonds. The Reserve Bank of Australia, QT. So this is a global QT. So the debts and deficits argument is definitely sort of a pile-on to what was already a vulnerable situation. And I think what's most alarming is the speed at which we're seeing these yield moves. I mean, the U.S. Treasury market is trading like a 2021 meme stock. And that is disconcerting when you see that. And to tie it into the argument about, well, we should have termed out all this debt, I think what you're seeing in terms of volatility in the long end of the bond market is why they weren't able to, because there wasn't enough demand for 30-year treasuries, call it, or even 20-year treasuries, which they reintroduced in 2020 for the first time since the 1980s. That trades like in its own world. It's the 20-year yield is above the 30-year yield because just the lack of demand. So I think this has a ways to play out. And while you talk about normal, there's nothing normal about this. There's nothing normal about the U.S. housing market being totally upside down. I mean, to see a rise in mortgage rates and no decline in home prices, that is highly abnormal. So I think this is just going to take time. It's unusual. And you know what? Taking a step back and being humble, we've never seen this before in terms of global QT. We never saw zero rates. We never saw negative interest rates. This is all experimental.
And we're now seeing supply chain at zero too.
What's that?
A supply chain that went to zero too for a moment.
This is highly unusual.
Mike, because there's this important point here, Peter, which you said is so true, which ultimately is, I think, at the core of the situation, the bond market trading like a meme stock. It sounds like hyperbole, but there have been moments the last few years where that has frankly been true. No matter what side you're on in the debate, you have to recognize that the volatility in bonds is possibly a problem, at very best, not the way it's supposed to work. But throughout all of that, Mike, the dollar has remained strong. The dollar has been firming. Now, last week, the dollar broke down pretty hard. But from a technical perspective, if I were thinking the market were making a referendum on the U.S. solvency issue because of the things we're talking about here today, our dollar would be crashing. How come the dollar's been so strong? By the way, we have 5 minutes, despite how volatile the bond market is for that country.
So the dollar right now is a wrecking ball, unstoppable force, partly because in U.S. Treasuries, the safest assets on the planet, you can guarantee in a T-bill you're getting 5.4%. You can't do that in any place in the world that's even close. In Canada, what is it, 4%? In Europe, maybe 4%. And then the top other countries on the planet, China, 2%. Germany, 3%, Japan, less than 1%. That's an unstoppable force. That's a hard hedge. So if you're short the dollar, it's a very negative carry trade. And then, by the way, we have these wars going on. I mean, that's part of the formation of this country. I know my relatives left Europe to get away from all the wars and a lot of the in Europe. A couple hundred years ago, we were peasants. We got sick of fighting the war, and just the nature of what's happening. So let's think about what's happening there. And then I like to point out is, by default, it wins. There's just no other way. If you look at why do they trade Bitcoin in dollars in every country in the world? Why do they quote it? Because the dollar is the default. There's nothing even close. Remember the euro? I thought, okay, it was going to be a great deal. It's maybe on a 1 to 10 scale, dollars a 10 in terms of currencies and everything else is a 5. But the key thing, I think, is looking forward. What has been the primary leading coincident measure of what's boosted the dollar for the since 2009 is that's the U.S. stock market outperforming the world. If you take the S&P 500, you divide it by the MSCI ex-US, it's tick for tick going higher. So what's going to take for the dollar to not break the
creating
global
wealth?
that is part of it, yes. I mean, and it's a lot of it's tech, and the U.S. does that better than everyone else. But at some point, it always gets too expensive. 1929, many other examples in history, early 70s, 2000. That's what I'm calling for as a normalization. But the key thing is the dollars can keep breaking things until the U.S. economy contracts, rates go down, and the stock market goes down relative to the rest of the world. That's just the way it has been. Maybe there's something different, but just a little reversion in that trade, I think, is significant. So I like to point out gold. There's a one asset I like to ask anybody in the room. They know any major asset, the average price this year is the highest in its history. Gold in U.S. dollars. Now, if you gold in every other currency, it's higher. So the average price this year is 1931. It's almost 1933. That was a great year. That's when we went off the, we confiscated kind of a gold standard. And right now it's 1990, 1,990 in US dollars. I look at that as just a matter of time that in the history of the dollar per ounce price of gold versus the S&P 500, they've been playing cat and mouse since we came off the gold standard in 1971. And every time we go in recession and gold's well below the S&P 500, it just reverts up. That's about $3,000.
Your chart work on gold has been great. We've got 2 minutes. If we can do because I think we just got some of the answer, but for each of you guys, a minute on kind of, if I were to tell you, GDP is going to go down from here, inflation's going to go up, our kind of standard definition of stagflation, what do you do?
Well, I think you have to look at the commodity market. And to me, I think a lot of people look to commodities for inflation or stagflation because it existed in the 70s and 80s. And I think, not to state the obvious, but the inflation markets are really new. The U.S. Treasury only started the TIPS market in 1997, and TIPS have a lot of problems. They're all long duration, so all of the bonds lose money as yields go higher. And then the only index, per se, it's like the only index inside TIPS is the consumer price index. And that's not even an index that the Fed uses. They keep talking about core, they'll talk about PCE or survey data. So I'd say, I think it's a really important time to add inflation protection to portfolios, but in the rates markets, not, have your allocation to commodities, have your allocation to gold and other things. But I think inflation protected bonds look really attractive given how high real yields are, but you have to fix the problems that are inherent with TIPS.
I thought for sure we were going to get an IVOL mention there.
I was going to mention that as owner for our clients of IVOL is having the inflation protection, the volatility exposure,
A quadratic
long
product.
vol. Yes, so I would buy that if I were you. In addition to, when you look at the last couple of years, what have been the safety trades? There's been energy stocks and gold. You told me that real rates would rise. Look at the 5-year real rate, 450 basis points from minus 200 to plus 250 over a 2-year time frame, and gold would be up. I would not make that connection, but it is. The stickiness in the dollar and gold is up. There is a tremendous underlying bid for gold that makes us long and bullish, in addition to silver, too, as a derivative of the gold.
Mike, 30 seconds.
The deepest pockets on the planet are buying gold, central banks. And the latest in the World Gold Councils is, they can print money and buy gold. What's going to stop them? So I look at U.S. Treasuries across the curve around 5%. I think this time next year, they're going to be around 3%. And gold is going to be about closer to 3,000.
No crypto mention. That's the next panel. And I'm definitely not on that panel. Nancy Davis, Peter Bookfar, and Mike McGlone, thank you very much. I'm Oliver Rennick. Thank you, guys.